TSX very close to breaking the 27,000 level for the first time. Jamie Murray joins us now for a look at the markets. Jamie is president of the Murray Wealth Group. Great to see you as ever.
Thanks.
Thanks very much for coming in. Markets at record highs. Is there too much optimism out there?
I don't think there's too much optimism, and we're still long-term bulls on the market. These interest rate cuts are going to flow through and help some of these struggling sectors like housing and real estate and some of these laggards, and we're seeing that right now in the markets. But at the end of the day, the leaders, this big AI trade and the technology stocks, are going to continue to propel the market higher from here, we think.
And you were too polite to set me straight there. TSX poised to break 30,000 for the first time.
Yeah, right. Yeah, exactly.
Yeah.
Yeah, and I mean, it's about, I think, 1% away right now. Yeah. And so we're on the verge, and I think it's going to happen soon.
I got mixed up there. We were just shy of 29,700, so we're only a few points away from that. Because so far, no sign of a serious downturn in the United States economically.
No, I mean, things continue to track well. The Atlanta Fed puts out a real-time GDP estimate every quarter, and that's tracking above consensus estimates. And like I said, I think these rate cuts in both Canada, even globally, we're in a cutting cycle, and that's just going to continue to provide support for a lot of equities around the world, and we think provide a little lift to markets.
You argue that we have a fairly concentrated market in Canada, too, with the top 10 constituents in our index, almost 40% of the total valuation.
Yeah, exactly. We hear about how the Mag 7 and those type of companies in the U.S. dominate the S&P. They're 35% of the index there. But in Canada, we're just as concentrated with it. I think it was around 37, 38%. And again, the big five banks are in there. You have Shopify, Agnico Eagle, I think Brookfield, and CP, and one other that's slipping my mind. But again, it's a very narrow group that also is driving markets here, and so that's just something that index investors for sure still want to be aware of what's really in the index.
And you have been lightening up a bit on the banks, the big Canadian banks, Jimmy.
Yeah, exactly. Yeah, we have. So we our two biggest holdings in the banking sector in Canada are TD Bank and Bank of Nova Scotia. We bought a lot of TD last year when they were having some troubles with their anti-money laundering problems, and despite being a very real problem and one that needs to be fixed, we think it was a shorter-term issue. And Bank of Nova Scotia, we think, is the best positioned bank in Canada for short-term interest rate cuts. That helps out their funding costs. So those are why we like those two banks. But I mean, you can see they've had huge moves year to date, and really off that bottom in April. And we definitely still see some risks. And Canadian real estate is a little fragile right now. We don't have resolution yet on the Canada-U.S. tariff situation, so we're taking a bigger look and saying, yields on the banks have come down. Maybe it's time to lighten up on them if you're overweight.
But you're still drawn to those Mag 7 stocks, the tech names, Jimmy?
Yeah, ultimately, if there's one thing you need to know about the AI trade and the tech trade, is that demand is still outpacing supply. We're seeing that in lots of real-time data indicators. So now we're into the inference phase. So 2 years ago it was training these models. Now it's using the models. And we still think we're early days in this. And every indicator we're tracking, and every expert we talk to, every conference call we listen to, it's demand can't keep up, or supply cannot keep up with demand. And that's going to continue, we think, driving this market and driving these stocks higher until that starts to shift.
NVIDIA, Broadcom, Qualcomm would all be among your favorite names, sir?
Yeah, definitely. Outside of we own 4 of the Mag 7, I guess 5 if you include defense. It seems like it changes what's actually in the Mag 7 or the Mag 8, but I think we own 5 now with NVIDIA, and certainly the chip stocks are the leaders in this because they're the ones who are enabling all of this. But I think we just kind of want to start to shape our view to what is going to be, where the economics going to be accruing in a year, 2 or 3 years down. And that's where we start to see maybe a Qualcomm. It's a company that trades at just a 12 times multiple. They have some short-term headwinds with their cell phone business and Apple dropping down some business. But longer term, I mean, this is a company that's winning business in the auto market. As AI moves into devices, we're going to have more devices connected to the cell phone networks. And they have a really great platform, we think, for potential robotic applications as we move forward. So there's a lot of optionality in a stock like Qualcomm as AI grows. And with NVIDIA and Broadcom trading at 35 PE ratios and Qualcomm trading at 12. Now, you're not going to get the same level of growth, but at a 12 times multiple, way lower than the market in aggregate, you think Qualcomm is a great play here.
And you have some income ideas for us here in Canada, including some REITs, Northwest Healthcare.
Yeah, so with rates coming down, we're hearing we're hearing from clients is, hey, I have a GIC that's maturing. I was getting 5%. Now when I talk to the bank, it's going to be 2.4% on the next round. So what can we do that's better than that? And so we're looking for some high dividend paying companies that have very secure yields and that we think there's upside to on the capital appreciation side from their yields coming lower, and also just a bit of a turnaround story. Northwest Health fits the bill. They own medical and hospital assets around the world.
I'm sorry, Larry. Jamie, it's nwh.un.
Yeah, nwh.un.
Carry on, Jamie, please.
That's the ticker. The stock hasn't really moved too much over the last year, but there's a new CEO. We just had a meeting with him this week. We really like what he has to say. He's going to consolidate some operations, sell down some assets to bring the debt even lower. And ultimately, you're going to be left with, we think, almost a near infrastructure-like asset base, because these medical properties they own are government funded in a lot of cases, recession resistant, and with a yield that's just still over 7% and a payout ratio that's going to continue to decline into next year, we think it's a really attractive opportunity.
And then there's one other you have here, or at least one other, Flagship Communities. Is the symbol MHC.UN? Is that right?
Yeah, there's two different tickers for this one, for the Canadian, the US. There's two options. You can buy it in Canadian or US dollar, but MHC.U. Is Flagship, and Flagship owns mobile home and manufactured housing communities in the United States. And with housing still really unaffordable, and in the U.S. it's actually getting worse, we're still seeing prices rise and really tight markets. And so Flagship is a great opportunity for lower and middle income, middle income market to actually have some ownership in their home, and it's a great company with a very secure land package.
Flagship MHCU in Toronto up almost 30%, including distributions in the past year.
Yeah, exactly.
Thank you very much, Jamie.
Thanks for having me.
Jamie Murray, president of the Murray Wealth Group.